We all want to build wealth and live comfortably. The question is, how do you do it? Across the world, the cost of living is getting higher and higher, making it hard to understand how anyone's able to get ahead. But for many, the answer is simple: the financial markets. Truth is, the market is full of opportunities, and not just for the rich, but for everyone. And you may be surprised to know that making money in the market isn't all that hard. By learning the same strategies that professional traders use to read the market, you too can build a strong portfolio and achieve early financial freedom. We've taken the insight and knowledge from over 200 books and 10,000 hours of professional trading experience, and distilled it down into a series of fun, bite-sized tutorials that will teach you the trading skills necessary to start building your long-term wealth. This series is divided into 5 categories. First, the basics of trading and investing, where you'll learn the different ways you can build wealth in the market. Second, riding the big market cycles, where you'll learn how to catch the big moves in the markets. Third, the ABCs of stock valuation, to help you select the best stocks to trade. Fourth, behavioral analysis and market timing, where you'll learn how professional traders predict the market to earn consistent gains. And finally, making your first trade, where you'll put all your new knowledge to use. So, what do you say? Ready to take your first step towards building some wealth? Then choose your first category and let's begin. When you work a job, you're basically exchanging time for money. The more hours you work, the more money you make. It's a good way to get by, but a bad way to build wealth, because eventually you simply run out of hours. That's why if you want to grow wealth quickly, you need to make your money work for you. How? By investing and trading in the financial markets. Okay, so think of the financial markets as a garden where you grow wealth. Just like you plant a seed and watch it grow, in the financial markets, you can invest a small amount in companies, real estate, foreign currencies, and other securities, then share in their profits as they grow in value. And thanks to a financial principle called compound interest, your take becomes bigger and bigger every year. For instance, let's say you invest $1,000 in Company A. In the first year, they grow 15%, meaning you make $150, bringing your total to $1,150. Then the next year, they grow another 15%. But instead of making 15% on $1,000, you make 15% on your new total, $1,150, which translates into $172.50 for the year and $1,322.50 total. Do this a couple more years and you will have doubled your money without lifting a finger. But if you never invested that $1,000, you wouldn't have earned anything. In fact, your money would have decreased in value due to the rising cost of living, or inflation. Even with an inflation rate of 5%, that $1,000 would have lost a third of its value in 10 years. So clearly, investing is the better way to go. But how do you do it without taking on too much risk? First off, you should put enough money into savings and insurance to protect yourself in the event of a downturn or adversity. Second, if you're just starting out, you can focus on regular investing or trading. Regular investing allows you to accumulate wealth in the long run, while trading enables you to capture consistent short-term gains to grow your capital quickly, provided you understand behavioral analysis and market timing. Finally, once you've established a large capital base, you can choose to buy and hold for the long term to generate capital gains and passive income, or use long-term trading strategies to manage your portfolio effectively. But those are just the basics. There are many instruments for trading and investing, and in order to grow wealth on the market, you'll need to understand how they work. So next, let's take a closer look at one of the most common types of investments: stocks. The stock market is a great place to generate wealth, but before getting started, you have to understand a few basic terms. For instance, stock, share, and equity. They're all synonymous, all representing a partial ownership of a company. So if you buy stock in Apple or Singtel, you officially own a share of the company. Buy 1,000 shares in a company that offers 100,000 shares, and you own 1%. Owning shares allows you to benefit from a company's growth and profits in the form of capital gains and dividend payouts. Capital gains represent the difference between the purchase price of an investment and the eventual selling price. So if you buy one share of a company for $1 and eventually sell that share for $5, you receive $4 in capital gains per share. A dividend payout is the percentage of a company's earnings that get paid to shareholders who have stock in the company, usually on an annual basis. Those are the basic terms. Now, let's look at basic market function. It all starts when a company decides to sell its shares in an initial public offering, or IPO. This is when a company goes from being totally private to one that is owned and traded by the public. Once on the stock market or exchange, you can purchase stock in that company through a stockbroker, along with other companies also listed on a stock exchange. Which leads us to our next topic, how to choose which types of stocks to buy and trade. One way is to separate them by sectors, like financials, real estate, healthcare, technology, and so on. Another approach is to divide them based on the size of the companies, also known as market capitalization. On the low end are penny stocks, which are cheap, volatile, but offer high growth potential. Then there's mid-caps, which provide solid growth potential with less risk. And on the high end, blue chips, which are usually larger with strong track records, more stable companies with higher stock prices. Finally, you could check out stock indices or indexes. These are used to measure the value of a particular section of the stock market. For example, the S&P 500 index tracks the performance of 500 companies in the US markets, giving us a good overview of the health of the overall US markets. And in Singapore, there's the Straits Times Index, which tracks the performance of the top 30 companies listed on the Singapore Exchange. Every market has its own benchmark, and tracking the indexes is a good way to determine the direction of the market overall. So those are the stock market basics. Next up, let's explore some of the other products that can be found in the financial markets. Just like the seasons, financial markets go through cycles. And by applying basic economic principles and portfolio strategies, you can capitalize on these big market movements to either ride the wave or weather the storm. In general, each market cycle lasts about 4 to 5 years, and within each cycle are usually 6 stages. During each stage, certain asset classes outperform others. That's why it's important to buy the right asset class at the right time, and to always hold a good mix, which diversifies your risk. So what are the 6 stages of the market cycle, and what should you do in each? Let's start with stage 1, which begins with the market contracting. This is a good time to buy bonds, as central banks will lower interest rates and expand the money supply to improve the economy, thus boosting bond prices. During the second stage, as the market hits bottom, you'll want to buy more stocks, especially in financials. You can buy them cheap and hold on to them as the market turns around, as it did from 2003 to 2007. As the bull market progresses into stage 3 and the economy kicks into full gear, there will be an increased demand for raw materials, which will lead to inflation, making it a good time to buy inflation-sensitive products such as commodity tracking ETFs. Then, during the fourth stage, as the bull market reaches the late stage, you'll want to reduce your bond holdings as they'll be peaking. In the fifth stage, as the market hits its ceiling and stock prices are maxing out, you should look to reduce your stock holdings in favor of more commodity ETFs. For example, when the stock market declined in late 2007, stocks dropped significantly, but commodities continued to climb. Meaning, if you had swapped stocks for commodities when the market was peaking, you would have avoided losses and made a profit, even as the stock market weakened. And finally, there's the sixth stage of the cycle, when the economy contracts and all asset classes begin to decline. This is a good time to acquire defensive stocks, like public transportation and healthcare companies, which are less affected during downturns. Of course, if you're a long-term stock investor, you may not need to switch around asset classes, as long as you're able to stomach the big market corrections. You can take the buy and hold approach instead and accumulate fundamentally strong stocks, and profit during stages 3 and 4 as the market expands. So, those are the basic principles of market cycles. Next, we'll dig deeper and figure out what causes the market to move in the first place. We've seen how the markets move in cycles, but what are the factors that govern those movements? It's many things, but they can be grouped into 2 main categories. Fundamental factors, like monetary policy, balance of trade, and unemployment. And behavioral forces, like how people respond to these policies. These two factors are always playing off each other in a series of actions and reactions, like a cause and effect loop. Now, as an investor, the key is to focus on the sequence of events in the business cycle and identify clues to determine what's coming next. In general, the market goes through two phases: expansion, which is generally good, and contraction, which is generally bad. During the early stages of expansion, the recovery is driven primarily by fundamental factors. As economies expand and trade and employment picks up, central banks usually tighten their policies to keep inflation down, which is good for stocks and bonds, but not so good for commodities. These fundamentals lead to a rise in stock prices, which only encourage more people to jump into the market. It's good at first, but as this greed and exuberance spreads, stock prices eventually outpace their actual value. This leads to inflation, which is marked by an increase in commodity prices. To counteract these behavioral forces, central banks usually step in and increase interest rates, which help curb the money supply and decrease inflation. This action signals that the expansion is ending and stocks will soon be on the decline. But it also means that commodity-related products will be going up. If you're aware of these signals, you'll know that this is a good time to switch from stocks to commodities. Then, during the recession that follows, behavioral forces will become stronger than ever. As more people realize that the stock market is declining, fear and panic will spread, forcing even more to sell off their shares. During these periods, savvy investors will reduce their stock portfolios and wait for the market to turn around. Which they will, because eventually, central banks will step in and cut interest rates to increase the money supply. These fundamental drivers will lead to a rise in stock prices, making it the perfect time to jump back in the market. And that starts the cycle all over again. Now, as an investor, it's important to recognize these signals and never lose sight of the bigger picture. It's like Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." So keep an eye on the fundamental and behavioral factors that move the market, and always stay one step ahead of the game. To be a successful value investor in the stock market, you need to know how to identify which stocks are the most valuable. But the most valuable stocks aren't necessarily the ones that are performing the best. In fact, the real goal is to find stocks with strong intrinsic value that are currently undervalued by the market. So, how do you identify these gems? First, find the right type of business. In general, you should always start with what you know. For instance, if you're familiar with the technology sector, you may want to look there. Just make sure that the industry isn't experiencing long-term challenges. This will help you avoid eroding profits in the future. Next, look for a company with a strong and sustainable competitive advantage. For instance, if a company has a patent on an emerging technology, this could help them for years to come. Finally, make sure the company has strong growth potential and a clear strategy for the future. Is there a growing demand for their product? Do they have the infrastructure necessary to expand? Questions like these can help gauge their future success. The second way to identify intrinsic value is to study a company's management team. Do some research, see if they have the proper credentials, and make sure that their skill sets are well suited for the current business climate. And of course, look at their track records. Were they successful in their recent positions, or did they leave those companies weaker than before? And are they transparent with their shareholders? Executives who are open to new ideas and willing to adapt are generally more capable of overcoming future challenges. Next, have they laid out a clear plan for future growth? If not, you should be concerned. And how are they paid? Do they receive a flat salary or is it performance-based? And do they own a significant stake in the company? Executives who are themselves invested in their company's success are more likely to put their shareholders first. The third and final way to identify intrinsic value is to analyze a company's financial numbers. But this topic requires a lot of attention, which is why we'll cover it in our next video, Reading Financial Statements. If you really want to know how a company is doing, you need to read their financial statements. It's the fastest and most reliable way to know if a company is doing well or struggling to survive. There are three different kinds of financial statements: the balance sheet, the income statement, and the cash flow statement. First, let's start with the balance sheet. This summarizes a company's assets, liabilities, and equity at a specific time. Assets are broken down into two categories: current assets, which include cash and highly liquid investment securities, and non-current assets, which include any property, buildings, plants, equipment, and company software. Next are the company's liabilities, which are also broken down into two categories: current liabilities, which include bank loans, accounts payable, and other payables like payroll and accrued expenses, and non-current liabilities, which include any long-term loans or financial obligations. If you subtract the total liabilities from the total assets, you get the total shareholders' equity. Now, let's move to the company's income statement. This measures how much profit or loss the company has made over a specific period of time, which is why it's also referred to as a P&L statement. First, you have revenue, which is the amount of money the company makes by selling products or providing services. Next come COGS, or cost of goods sold, which is the amount spent producing or acquiring the products or services, including material and labor costs. Subtract COGS from revenue and you've got gross profit. Then come the operating expenses, which include day-to-day things like marketing costs, indirect labor costs, and so on. Subtract that from gross profit and you've got operating income. Next, take that number and subtract all other miscellaneous expenses and you've got the company's profit before taxes. Subtract the taxes and you've got the net profit. And that leads us to the third financial statement, the cash flow statement. This measures how much cash flows in and out of a company over a specific period. Because a company's revenue and expenses can be delayed or deferred, this shows the actual cash flowing in and out of the company. First, you add together the cash flows from all operating activities, including profit before taxes, trade and other receivables, and trade and other payables. Then you add the cash flows from investment activities, along with the cash from financing activities. You then compare the cash at the beginning of the financial year to the cash at the end to determine if the company had a positive or negative cash flow. And that's how you read a company's financial statements. In our next video, we'll go even further and learn what these numbers actually mean. Reading financial statements is one thing. Analyzing them and deciphering their true meaning is another. To do that, you need to understand the 7 essential financial ratios. They're like a shortcut for filtering out good stocks. The first is gross profit margin. This represents the proportion of money left over after subtracting the cost of goods sold. To calculate gross profit margin, take gross profit and divide by sales. The higher the margin, the more profitable a company is. Margins of 15% or more are considered good. The second ratio is net profit margin. This represents the portion of money left after subtracting all expenses. To calculate net profit margin, divide net profit by sales. The higher the margin, the more profitable the company is. In general, look for margins of 7% or more. The third ratio is return on equity, or ROE. This measures how much profit a company makes from shareholder equity. To calculate ROE, take the net profit and divide it by equity. The higher the number, the more money the company makes for its shareholders. Look for an ROE of 15% or higher. The fourth essential ratio is the current ratio. This measures a company's current assets against its current liabilities. To calculate the current ratio, simply divide the current assets by the current liabilities. The higher the ratio, the more likely the company will be able to cover short-term liabilities. A good current ratio is anything above 1. The fifth ratio you should know is the debt-to-cash flow ratio. This measures a company's debts against its operating cash flow. To calculate this, take the company's total debt and divide it by operating cash flow. The lower the ratio, the better the company's ability to finance their operations. Any ratio less than or equal to 3 is considered good. The sixth essential ratio is the net gearing ratio. This measures a company's debts against its shareholder equity. To calculate this ratio, first take the total debt and subtract the company's cash. Then divide that number by the equity. The higher the ratio, the more debt and therefore risk the company has. Look for a net gearing ratio of 0.5 or less. Finally, the seventh essential ratio is the dividend yield. This measures how much in dividends the company pays out compared to their stock price. To calculate the dividend yield, take the dividend per share and divide it by share price. The higher the yield, the more dividends shareholders receive. Look for companies with consistent yields between 4 and 7%. And that's it. By applying these 7 essential ratios, you too can uncover hidden gems in the stock market. The price of every stock or financial product fluctuates over time. And no matter how strong a stock is or how solid its fundamentals, you can only make money when the stock goes up in price relative to where you bought it. That's why it's so important to read the market accurately and buy stocks at the right time. The goal for any investor is to buy a stock just before it makes a big move and sell it just before it starts to decline. The question is, how do you do it? For starters, you want to look at the big players on the financial landscape, like banks and financial institutions. These are the organizations who determine the direction of a stock more than any other. If they start to buy a certain stock in large numbers, chances are other investors will follow suit, leading to a rise in value. And if they start to dump a stock, then other shareholders will likely do the same, causing a decrease in value. By keeping a close eye on what these institutions are doing, you'll be able to spot shifts in the market before they happen. This study of market behavior is known as behavioral analysis and encompasses 3 main schools of thought: classical technical analysis, indicator-based technical analysis, and price action and volume analysis. Classical technical analysis is all about reading charts. The goal is to identify the trend lines of a particular stock and pinpoint the support and resistance zones where buying and selling usually takes place. Classical technical analysis also includes pattern recognition techniques, used to identify shapes on the chart which have a certain predictive value. Then there's indicator-based technical analysis, in which you take price and volume data and plug it into a mathematical formula to figure out when to buy or sell. Unfortunately, most indicator signals tend to be lagging, which can result in misleading or inaccurate analysis. Finally, there's price action and volume analysis, in which a trader leverages their deep understanding of market movements to interpret price and volume data directly. It's the methodology that most professional traders use, as it allows faster and more accurate predictions. Those are the basics. Over the next few videos, we'll dive a little deeper and teach you how to identify market trends and, most importantly, how to pinpoint the right time to buy and sell. If you want to make money by timing the stock market, you need to follow the trends. Buying and selling creates its own momentum, and a market that's moving up or down is likely to keep moving in that direction for a certain period of time. What this means is that you should avoid trading against the current trend. For example, when the market is bearish and heading down, don't try to predict which stocks have hit bottom. That would be like trying to catch a falling knife. Instead, find an objective way to both identify the current trend and decipher when that trend has changed too. Because just like the saying goes, the trend is your friend, except at the end. So let's explore 2 simple techniques for identifying market trends. The most common ways to look at the nature of a trend's movement. As a stock moves up or down, it rarely does so in a straight line. Rather, it zigzags, forming a series of highs and lows. If the highs keep getting higher and the lows keep getting higher, that stock is in an uptrend. If the highs get lower and the lows get lower, you're looking at a downtrend. And if the highs and lows are consistent over a certain period, it's in a sideways trend. Another way to identify the market trend is to look beyond the daily price fluctuations and determine the general direction of a stock. You do this by calculating an average. For example, a 20-day simple moving average, or an SMA, is an average of the past 20 days of closing prices, which moves or updates on a daily basis by incorporating the latest prices. If the SMA is sloping upwards, that's an uptrend. Sloping down, downtrend. And sideways means flat. A 20-day SMA gives a good picture of the short-term trend, but you can also use other periods, like the 50-day SMA and the 200-day SMA, for the long-term trend. Those aren't the only moving averages, however. There's the exponential moving average, or EMA, and the weighted moving average, or WMA, which gives more weight to recent prices. As a trader, you can use any of these techniques individually, but for the most accurate picture of market trends, you should use them all. Because when it comes to behavioral analysis, the best way to increase your chances of success is to consider as much data as possible. So that's market timing. Next, let's cover support and resistance zones. So far, we've covered the importance of market timing and the need to trade according to the current trend. But when exactly should you be buying or selling a security? This brings us to the topic of support and resistance zones. Support and resistance zones are like invisible lines on a price chart, which prices and traders react to. They signal a great opportunity to either enter or exit a trade. These zones usually correspond with the pattern by which a particular security has moved in the past. For instance, let's say a stock reaches a certain price level before declining. It goes down for about a year before hitting its bottom and turning back up again. The next time that stock approaches the price at which it first began to decline, some investors will start to sell it off, anticipating that it will decline once again. This is how a resistance zone is created. On the other hand, when that stock approaches the price at which it last turned around, many investors will step in and buy it, creating a support zone. Securities sit in these zones temporarily, while buyers and sellers try to figure out whether to jump in or jump out of the market. The key is to watch carefully how prices react in the support or resistance zone, because eventually one of two things will happen. The zone will either hold and the price will reverse direction, or the security will break through and continue on its trajectory. It's important to note that breakthroughs have the tendency to recalibrate a security's support and resistance zones. For example, oftentimes, when a security breaks through a resistance zone, that same level becomes its support zone during the next cycle. That's because of all the investors who missed the chance to benefit last time around, and are looking to either buy the security for cheap or sell it before it declines. As a trader, it's important to learn how to identify the support and resistance zones for a particular security. Once you've figured out where those zones are, you should then make your buying and selling decisions near those zones. That will provide you with a market edge, allowing you to achieve greater success over the short and long term.